Oh, if only. Our view is that we've probably seen the best for this year. Economic data to us are starting to look soft. We've been concerned about the direction of profitability and productivity. So we're concerned that we don't see a huge sell-off yet in the cards. Think the bond market will telegraph that to us. But think the rest of the year may just be really more stock trading.
You know, I think the market is really torn between, like you said, the horrid numbers in Q1 GDP and the much better economic data that we're seeing most recently. And maybe this week is going to be the resolution, because if the non-farm payrolls really prove to be much better than expected, they could provide that lift to yield that we've been talking about. But I think ultimately the conversation is going to have to change away from job growth to wage growth. That's really what the bond market is watching. That's why the bond market is utterly complacent about inflation worries. That's why you're seeing the yield at 2.5. If we start to see average wages begin to percolate higher, that's going to be the signal that the Fed may eventually begin to tighten. And I think that's when you're going to start to see U.S. rates go up, and that's when the dollar will finally catch a bid. The bigger question is, are we more like Japan? Is this just another series of endless false dawns, you know, or are we going to just actually finally snap out of it in a real fashion? And again, I think the snapping out of it in a real fashion will be a function of wages.